This is Trading Lesson 28, delivered by Togbe Ezekiel. It is for forex traders, crypto, stock options, and other chart-related traders. You can contact us for account management, training, consultation on +234 803 75 97085. You're advised to subscribe, share, like, and make comments on this broadcast. When a pullback forms in a bull trend, it is a bull flag. When it occurs in a bear trend, it is a bear flag. It is often contained between a conveying trend line and trend channel line. When this is the case and it is horizontal, it is a triangle which can break out in either direction. However, when it is falling in a bull trend or rising in a bear trend, it is called a wedge. And like all pullbacks, it will usually break out in the direction of the trend. Like other types of triangles, it has at least 5 legs. But unlike a typical triangle, the second leg often exceeds the prior swing point. It can be just a simple 3-push wedge pattern or a channel. After a spike, it can also assume an irregular shape that looks nothing like a wedge but has 3 counter-trend pushes, which is all that is needed to qualify as a triangle, or it is sloping. A wedge type of triangle, or simply a wedge. A wedge pullback is a with trend setup, and traders can enter on the first signal as soon as the market reverses back into the direction of the trend. Wedges can also be reliable reversal patterns, but unlike a wedge pullback, a wedge reversal is a counter-trend setup, and it is therefore usually better to wait for a second entry. If a wedge reversal forms in a bull trend, the wedge is pointed up, unlike a wedge pullback in a bull trend, which is pointed down. The reversal usually needs to be at least 20 bars long and have a clear trend channel line to be strong enough to reverse a trend. The wedge is usually the end of a trend, and the pullback is a small trend, but it is in the opposite direction of the larger trend. So it makes sense to view a wedge pullback as similar to a wedge reversal. In general, if a wedge is sloping up and to the right, whether it's a pullback in a bear trend or a top in a bull trend, it can be thought of as a bear flag even if there was no prior bear trend, since it will usually break out to the downside. A low 3 is functionally the same as a wedge top, and in fact often is an actual wedge, and the high 3 should be traded like a wedge bottom. 3-push pullback often set up reliable with trend entries. Whenever traders see a pullback approaching a trend line, a trend channel line, a moving average, a prior swing low or high, or any other key price level, they should be alert for a setup that will lend to the end of the pullback and the resumption of the trend. All head and shoulders tops and bottoms are really head and shoulders continuation pattern, because they are trading ranges, and like all trading ranges, They are much more likely to break out in the direction of the trend and only rarely reverse the trend. The same is true for double tops and bottoms. The head and shoulders bottom in the bear trend is usually a triangle or a wedge bear flag and should break out to the downside below the right shoulder. The head and shoulder bottom in the bull market is a bull flag and should break out to the upside above the neckline.